Hi, my name is Mike Clark from Social Innovations Partners, and I'm going to be speaking with you today about raising funding through philanthropy and government in a way that can scale your new idea or social venture, or give you seed funding for a new idea or social venture. I want to talk about philanthropy and government acting as venture capital. Venture capital in the private sector works to seed innovation and new ideas, and there are certain trends in philanthropy and government that you can take advantage of that will allow you to successfully gain investment for new ideas. An overview of today, I'm going to talk about where's your enterprise in the general funding ecosystem. That's an important first step. And then I'm going to get into certain trends that we're seeing from the philanthropic and government sectors. This is very important to find out where your venture fits in the funding ecosystem. We are very familiar with traditional nonprofits on the far left, organizations that don't have a profit motive and rely mostly on grant support. But there's 4 other buckets in the ecosystem. There's a whole spectrum of other ways where you can position your social venture to achieve investment and potential scale and ultimately impact the lives of the people that you're serving for whatever outcome you're intending. Nonprofits with an income generating model are an example of an organization where you would have a customer but still would need some philanthropic or grant support to shift some of the risk in gaining investments and attracting those customers. So in this bucket, grant support is still on the table, but you could also seek potential equity from foundations, types of loans, and cash infusions. For-profit social venture kind of moves the needle a bit on the nonprofit, the traditional nonprofit model. You're stepping your feet, so to speak, into the for-profit social venture world. There's some very interesting types of funding and financing that for-profit social ventures can take on. Loan guarantees are becoming a much more common practice, especially in the philanthropic community, to provide backing for potential debt. And then similar to the nonprofit with an income generating model, the equity and the types of loans and cash infusions. Socially responsible businesses, you might have heard of B corporations, benefit corporations. Benefit corporations are a distinction they're a legal distinction, just like a 501c3 or an LLC that most states at this point have passed. You can register as a benefit corporation in Pennsylvania, Delaware, other states, and that would signal that you are a socially responsible business. Having a B Corp certification is another step in the process where you're certified by B Lab, meeting a series of metrics and a host of metrics. You could be an LLC and still be certified as a benefit corporation through B Lab. As a distinct certified body. Traditional for-profits, this would allow you, if you had a model, this would mainly be a financial first model with social impact, and you would look to develop environmental, social, and governance indicators. You'd be driven mainly by finance first and business decisions. Social impact would be secondary, but there still are ways to have impact as a traditional for-profit company. So as you design your new venture and your new product, you want to keep in mind, or at least try to navigate which bucket you fit in, because it's going to determine what type of investment you are going to take on to launch the venture first and then down the road. A very interesting trend in philanthropy and government is impact investing. There's $60 billion of impact investments. That's conservative. They're investments that generate both a financial return and social impact. Impact investing is an older practice, but now it's gaining buzz and attention. The Quakers, for example, were doing impact investing in the 1600s. and now a lot of philanthropy and government institutions are taking on the practice. There's new energy and innovation around it. For example, the Ford Foundation committed $1 billion to impact investments recently in the past few years. There's a private sector focus, but government and philanthropy also have a role to play here. There's an opportunity for people like yourself to take advantage of this current movement. There's a lower deal flow than was expected nationally and regionally up until this point. So there's behavior change in education that's needed both for social enterprise and social ventures like yourself, but also philanthropy and government entities to see how they can enter the impact investing field. It's a very, very promising field to launch new ideas and scale new ideas, new approaches to social problems. In terms of impact investors, this is the general range of impact investors. And you see on the top right corner is where the financial first investment meets impact first investment, what we generally define as impact investing. Philanthropy seeks social impact primarily first, where financial first, traditional for-profit investing seeks financial returns first. So this is really thinking about, as you grow your venture, you're thinking about how do you blend and prove social outcomes, and then what is your place in the financial returns that you're going to have. It could be sustainability, it could be simple repayment of a grant, it could be subsidized as well, depending on how high of an impact you're having. Grant support isn't totally inappropriate at this point, depending on your ability to prove social outcomes. The Amadiar network, founded by Pierre Amadiar he was the co-founder of eBay. This is how they structured their grant portfolio. And they fit similar to the continuum that you saw earlier, the ecosystem that you saw earlier. They fit into certain buckets depending on which financial model you have. So they still subsidize grants if depending on the expected direct impact to consumers or customers, where if the expected financial return is high, they take a more commercially driven traditional for-profit approach. As I mentioned at the beginning of this presentation, we have venture capital to seed ideas in tech and biotech and grow them over time to the point where they eventually exit and return profit for initial investors. We don't quite have an equivalent in the social sector to venture capital to allow us to seed new ideas and scale new ideas. However, there are promising foundations and government entities that are acting like venture capital to allow people that have promising ideas like yourself to launch them and test them and pilot them in a market and potentially scale them. So I'm going to go over some of the tools that are being used to scale social ventures now. Program-related investments are deployed by charitable foundations. Charitable foundations are traditionally required to give 5% of their assets every year to charity. Program-related investments allow charitable foundations to invest in for-profit social ventures, and it still counts against that 5% as long as it's aligned with their mission. There are social ventures and social entrepreneurs that are becoming very savvy at taking on program-related investments to seed and scale their ventures. Mission-related investments speak to the other 95% of assets in charitable foundations. Charitable foundations, especially those like the Mission Investors Exchange, the Global Impact Investing Network, and other groups are looking at creative ways to deploy the 95% of assets in charitable foundations that are meant for capital preservation and to continue the mission of those foundations. So they're looking to invest that 95% in mainly for-profit entities that either have a capital preservation purpose or an income-generating purpose that could return investment to the corpus. But they're looking to align that 95% with organizations and ventures that are aligned with the social mission of that charitable foundation. If it's a health-related foundation, they're looking to invest in health ventures. If it's a foundation that's focused on social mobility, they'll invest in social mobility ventures and so on and so forth. The implications here are that we potentially have a pool of capital on the sideline that's meant for innovation that can be both deployed by charitable foundations and taken on by social venture. Social impact bonds and pay for success contracts are an interesting tool to think about in later stages as you have a proven track record of social outcomes. They allow you to scale your solution, your proven outcome solution, whether that be around health or recidivism or social mobility or what have you, by allowing private investors to invest in the scaling of a proven intervention, and those private investors would get paid back based off a contract agreement through the government, depending on how successful the service provider was, in this case you, at delivering those outcomes. Outcome rate cards are a tool that's being deployed and piloted in several government entities now, where they're setting a price for an array of social outcomes. So if you build your venture around delivering those outcomes, it could be a natural scaling tool for your venture. The implications here for social impact bonds, they are quite complicated transactionally. This would be when you get into the later stages, but they can, again, serve as scale-up capital for the social sector. Opportunity funds and opportunity zones are another trend and tool to watch out for. They are an economic development tax incentive where if you locate your venture within a low-income census tract in the United States that's designated as an opportunity zone, you can take on funding from opportunity funds. We see a flow of capital into opportunity zones. It could be another line of investment to potentially take advantage of and keep your eye on. Other types of public and private equity for nonprofit organizations, participation nonprofits is a concept being discussed. It was created by Robert Shiller out of Yale, an economist, Nobel Prize winning economist, that would allow nonprofits to take on stock, similar to the way that publicly traded companies operate on the stock market. Philanthropic equity, capital without a financial return, just a social return. So you would go through a seed round, a Series A round, Series B round, until you achieve scale. Social impact syndicates allow for multiple impact investors, philanthropies, and government entities to invest simultaneously in a social venture. And convertible PRIs, so program-related investments that can be repaid back or converted into equity. We see a new paradigm here. So there are government bodies, government entities across the United States and very forward-thinking philanthropies that are looking to invest intentionally in social outcomes and deploy their capital in a more holistic way that aligns with their mission. So it's a really nice point in time for social enterprise, social ventures, even nonprofits to get into the game, so to speak, and achieve this new paradigm and take advantage of this new paradigm. There's some barriers. Practice is a barrier, I mentioned that earlier. Not all social ventures and social enterprises are savvy or even knowledgeable of new ways of taking on capital. They usually tend to operate at that far left end bucket, which is just generally go after grant support. And philanthropies and governments are getting more savvy at deploying impact investing, but there is still a gap in practice. Public policy can greatly incentivize the growth of investment in this sector. PRIs were a policy innovation in and of themselves. The Ford Foundation in the late 60s lobbied and successfully passed program-related investments, which has now deployed a lot of capital towards social ventures and social enterprises that otherwise wouldn't be there. And a marketplace where social ventures can look for a type of capital, and impact investors, philanthropies, and government can potentially deploy that capital in a marketplace. So these barriers are all addressable through practice. I would greatly encourage you to We, the Social Innovation Journal, we're launching a series and have launched several articles and podcasts on this emerging field of impact investing and what we call social innovation finance, funding and financing social innovation. Policy, there's always policy entrepreneurship. So entrepreneurs that are looking at new and creative ways to pass public policies that incentivize this behavior. Opportunity zones are a very recent example of policy entrepreneurship, where a group of entrepreneurs got that federal policy passed that will lead to more investment in low-income census tracts and social ventures that are locating in low-income census tracts. And then we see certain marketplaces developing that are allowing social ventures and social enterprises to nonprofits to meet impact investors, philanthropies, and even government entities. So the impact first market, IF market, is one of those that we have piloted in the past. And then I would certainly look at, especially if you're in the Philadelphia area, the launching of the ARTHA platform, which is going to be another tool for impact investors and philanthropies to meet and potentially even government entities down the road to meet promising nonprofit social ventures, even for-profit entities with a social mission. With that, I thank you. I would just like to reiterate, before going and diving deep into any of these potential funding structures, please look at the revisit these buckets to see where you are in the ecosystem. You could start as a nonprofit income generating model, for example, and then potentially pivot to a for-profit social venture, or start as a for-profit social venture and realize your solution or your entity actually functions better as a traditional nonprofit. So always keep that front of mind where you are, because it's going to determine what type of investment that you seek. So with that, I thank you and have a good day.